This is Agriculture Today, and I'm Shelby Varner with the K-State Radio Network. Dan O'Brien, K-State grain economist, kicks off today's show with this week's grain market outlook. He explains the current market and the WASDE Report Expectations. Keeping the show moving forward is an episode of the KFMA Podcast with KFMA economist Chelsea Plummer and Edward Jones financial advisor Alice Tunks-Jones as they discuss retirement account options for farmers and ranchers as employers and employees. A weather update with Chip Redmond in today's show. This K-State meteorologist touches on the drought monitor improvements as well as how the hurricane activity is impacting our weather. That and more is coming up ahead. You're tuned in to Agriculture Today, and we start our Friday show with a grain update with K-State grain economist Dan O'Brien. Dan, thanks for joining us today.
Thank you, Shelby.
Dan, starting our conversation off with what are futures looking like?
Overall, I think it's fair to say that corn and soybean futures have pretty much discounted any crop risk at this point. And that affects both the old crop marketing opportunities for Kansas farmers, other farmers that still have grain, they're waiting for a price run-up, as well as new crop bids. You can see it in yesterday's closes. I saw the July contract at $4.06 3/4, September at $4.25. So when you have a July just about ready to go off the board, and it's actually higher than September, at this time it shows you that probably had some short covering, i.e. all these people have been selling that contract, driving it down all the way through for about the last month, had to buy back out of their contract. So you saw that situation. So we were actually up 3 or 4 cents. December, new crop closed at $4.10. And I realized that when you start looking at new crop bids, that in most of the area, probably except for western Kansas where the feedlots are, if we stay there, it'd give us a cash price at $4 or below. So that's a challenge financially for people. The only way to beat that is to have just tons of bushels, just bushels upon bushels. And what we just talked about for corn is even more so for soybeans. Here you got July soybeans closed on Thursday at 11.42 3/4. Again, just a few days from going off the board. And August is at 11.17. So you have a 25 cent, 26 cent, I guess, premium of July over August. And again, really indicative of a lot of, I guess we call that managed money traders, i.e. speculative folks, those that add leverage to the market. We need them, of course, but they've been driving that price down, have had to buy back out. So it is as it is. Then you have November harvest futures on Thursday's close at 10.67 3/4. Those are actually sideways to a little bit higher from where they were in the last several days. So not original to me, but I was reading over the comments of some other market people, and basically we pretty much priced the risk out of these markets. We're assuming large crops, and of course we're going to talk here today yet about expectations for the USDA WASDE report, the July report coming out later today at 11 a.m. And you can see that expectation in the traders' estimates for crop yields. And for wheat, actually, wheat was pretty strong yesterday, up about 18 and a quarter cents. The July contract, 5.91 1/4. September, 5.83 3/4. So again, you've got a situation where you have a premium on the upfront contract just about ready to go off. And sellers that had been selling that contract for a long time, especially so in wheat, had to buy back out. And you see September, 5.83 3/4. Interesting to see way out there into next July harvest number, July 25 is 6.24. So here you have the July contract almost off the board today and this week, 591 1/2, and you've got the uncertainty about what will happen next year coming in 624 for next July hard red winter wheat harvest. So interesting days to watch for sure.
And as we're looking at this market, Dan, are you seeing any basis trends?
There are some interesting trends that have been happening on the basis side. For corn especially, here you see that in the Colby area, in the Dodge City area, and in the Hutchinson area, you see for bellwether elevators a pretty strong uptrend, a narrowing of basis. And that's been happening at the same time that futures have first dropped down pretty sharply and now are going basically sideways. So you do see a little bit of a response back for cash prices. Of course, if the upfront basis is doing that, that's showing that there are some buyers out there that are holding corn, in this case corn, in those areas, again, Northwest, Southwest, South Central, that the market still is trying to entice supplies out of their hand, i.e. to bring it to town. And to do that, you're seeing here at the elevators, the basis improving. And, you and I have been talking about for several weeks now. We have reports of bids from livestock feeders on a one-to-one basis where you see some 75 over basis bids. So you're coming down to the last part of the marketing year. Now we're in mid-July, then August, September will start to be wet corn available, and then on from there, where some people have some needs for the last bit of time here in this growing season. So we'll see where that goes. I would say for grain sorghum, if anything, over most of the state, except maybe for a little bit of an uptick in the Colby area, that you've got basis for sorghum sideways to lower. And that's indicative really of just so-so export strength. If we had continued strong grain sorghum export strength, we'd be seeing local cash basis at elevators being stronger than it is. I would also say for soybeans, basis is we're just entering into now the time frame where the last several years basis has just hopped all over the place. Just really swinging 50 cents a dollar, all that much more of it. But in that time, we have seen a little bit of an uptick now again in the Colby area, Dodge City, Hutchinson, a little bit in Salina, and others. So interesting to watch, I guess. Probably the question to ask there is how long will ample supplies be available in South America, which is our main export competitor. When that starts to slow down, then the U.S. would be more front and center for movement. We'll see. And for wheat, of course, we're in the middle of wheat harvest. And surprisingly, we've actually seen, during a time of really weak futures prices, Northwest Kansas, improvement in basis. Salina, last 3 or 4 weeks up stronger, especially in Hutchinson, a jump of about 40, 50 cents just in the last 1 or 2 weeks. Moderate strength in Topeka. Other locations pretty much sideways, Dodge City and Columbus. So here you got a situation here on wheat basis where weak futures, but probably, if we see bargain hunting, as some analysts are talking about happening, you see some foreign buyers coming in, sending signals up the way, up to Kansas to gather supplies, and elevators responding in kind to give some more attractive basis bids to try to secure supplies basically to fill trains.
Dan, you mentioned that the WASDE report is coming out today, July 12th, and you have a few pre-report expectations for us.
Yeah, the market's take on U.S. corn production, U.S. soybean production, still for strong yields. So here we have, I doubt the USDA will change at all their projection of 181 bushels an acre that they had in June. You do see just 180.8 bushels per acre as an average trade estimate by analysts. I did see a crop projections, consultant out of affiliated with the University of Illinois projected yields at just under 180. So either way you look at that, you're looking at about 15 billion bushels of production. That's what the USDA is projecting. If you get down to 180, then you get 180, 179 bushels an acre or so, then you're looking at something like, again, 14.9 billion bushels. And for soybeans, still projecting at 51.9, 52 bushels per acre. I doubt that'll change much from the USDA's last projection. Also a record high yield along with the 181 for corn, 4.4 billion bushels of crop. And I think, Shelby, as we talk about these markets in the next several weeks, we're coming into the prime time of pollination for corn, flowering, pod setting for soybeans over the next 45 to 60 days. And I guess, do we have enough maladies with cropland being over wet in some areas, dry in parts of the eastern Corn Belt, storm damage, et cetera, that we can still count on these high record yields? And the market, from a financial manager point of view, they're already there. They're assuming that. So we'll see. It's not the July report they'll start to tell that with more specificity. The August will start, but it won't have field surveys from the USDA. Then in September we'll really have more solid data. So you bring all that together. USDA old crop grain stocks, and we just had the June 28th grain stocks report. You bring that in and not anticipating much change really for corn, old crop stocks, or for soybean old crop stocks, slight increase. But I would say on those old crop ending stocks figures, as we talked about here before we came on the air, that we have a slow enough pace for U.S. exports in this old crop marketing year. I wouldn't be surprised if the USDA may tend to reduce export projections and actually could end up on the old crop stocks being higher than this. And then looking at for new crop bids, of course, they're driven all by the size of the crops. So I would anticipate not a lot of change, if anything, a little bit higher. Ending stocks figures, corn could be up 100 to 200 million bushels. That's what the trade's expecting. For soybeans, about the same or slightly lower. And on June 28th, along with that, the stocks reports, we had the acreage reports. So that's driving the ship right now. That along with continued assumptions of higher yields. And then there'll also be more information on world grain, soybean ending stocks. And, of course, we'll be watching Argentina, Brazil numbers. They're still reconciling, especially for Brazil, some of the differences between in-country and out. So we'll see where that goes. And there'll also be more information on wheat production. So I don't know that we'll see a lot of changes there. I would say, I know you've been following the wheat harvest reports. A lot of mixed numbers out there for yields, some outstanding yields, some not very good yields around the state. So I don't know where that will come in at. I don't think the market will pay much attention to that variability at this time, given the just so-so nature of our exports. So we'll see where all that goes.
Dan, I appreciate you taking the time to join us today and give us our grain market update.
Thank you, Shelby. I appreciate it.
That was K-State grain economist Dan O'Brien. We're cutting to a short break now, but stick around because we have more for you ahead. You're tuned in to Agriculture Today, and we continue our Friday show with part of the Kansas Farm Management Association's podcast. This podcast is hosted by KFMA economist Chelsea Plummer, and today she's joined by a financial advisor with Edward Jones, Alice Tunks-Jones, as they talk about retirement account options.
We're kind of trying to specifically focus on what types of account or retirement accounts and plans are available for self-employed individuals. What types of accounts are there that are available, and maybe share a little bit about some of the eligibility requirements for those.
So I'm going to start off with some that are probably a little more well-known. There's 5 different ones that I want to talk about. So your listeners are probably very, very familiar with the traditional IRA, traditional individual retirement arrangement. It's a tax-deferred account designed specifically for retirement savings. Advantages include contributions may be deductible, and generally amounts in an IRA are not taxed until they're distributed. So that one would be eligible for anybody that has earned income. And if you have a spouse, whether they work or do not work, they also have the ability to contribute if they are filing a joint return. And then the Roth IRA, it was created through the Taxpayer Relief Act of 1997 to provide an alternate to making non-deductible contributions to traditional IRAs. So the Roth IRA is a little different in the fact that it allows for after-tax contributions with the potential for tax-free income in retirement. And then people may be a little less familiar, but the Simple IRA, it stands for Savings Incentive Match Plan for Employees. It's a workplace retirement plan that allows employees to contribute to the plan through salary deferrals, and the employer is required to make contributions to the plan through a matching or non-elective contribution. The last two, Simplified Employee Pension, also known as a SET IRA. It's a retirement plan that allows the employer to contribute tax-deductible dollars to the owner's and the employee's retirement accounts. They are funded similarly as a profit-sharing plan in the sense that each eligible employee generally gets the same percentage of their individual compensation amount. And then lastly, Owner K plans. It's a 401k profit-sharing plan designed to allow business owners without employees, other than their spouse, to defer salary for retirement savings. And because they do allow pre-tax contributions, an Owner K plan can reduce the tax burden for the business owner.
What are the contribution limits? Because I know those vary quite a bit between some of these. So for them, what are the contribution limits each year?
So we're going to focus on 2024. The traditional and the Roth, you can do up to $7,000 a year. However, if you are age 50 and up, you can contribute an additional $1,000 as a catch-up. So a total of $8,000, and that is between the Roth and the traditional. And then there are spousal contributions for the non-working spouse. If the couple is married, files a joint return, and one of the spouses has to have taxable compensation. And then the deferral limit that's allowed is $16,000 for 2024. The catch-up for age 50 and up is $3,500 additionally. So if someone were 50 or older, they could do a total of $19,500 that they could defer into that themselves. The contribution limit on the SEP is the lesser of 25% of compensation up to $69,000. And there are no catch-ups on the SEP since that is strictly coming from the employer. The employee will not contribute to that one. And then in the owner K, the basic limit is $23,000 a year, and the catch-up if you are 50 and older is $7,500. So if you are 50 and older, you can do a total of $30,500 for 2024.
So some of these accounts are just for the individual, the taxpayers. Some provide options for them to do both for the employee and themselves. So I just want to make sure we clarify, which accounts would be a good choice if farmers are wanting to provide this retirement benefit for employees, or maybe what would be a good choice if they are choosing not to do that.
So the first two that we talked about, traditional IRA and then the Roth IRA, those are going to be set up by individuals. So the employer will not be contributing to those. Those are set up by the individuals. The simple is an option if the employer wants to contribute for the employee's retirement, and then the employee also can contribute for retirement. So with the simple, the employer is required to make one of the following mandatory contributions. A dollar-for-dollar match of the employee's deferral up to 3% of the employee's annual compensation, or a non-elective contribution of 2% of the employee's compensation, capped at $345,000 for 2024 for eligible employees. And then the employees can also be contributing for their own retirement. In the SEP, that is strictly going to be the employer. The employee cannot make contributions towards that. And then with the owner K, there is the ability for profit-sharing contributions, and then pre-tax contributions or Roth contributions if allowed for by the plan document. But remember, with that one, you can only have the business owner and a spouse that participate in the owner K.
So if someone has accounts set up, such as a SEP or a simple that they're contributing to, can they also still contribute to a Roth or a traditional IRA?
So the answer is yes. The thing to remember with simples, SEPs, and owner Ks, those are all employer-sponsored retirement plans. And the traditional and the Roth IRAs, those are individuals. As long as you have earned income, you can have a traditional or a Roth, and there's some limitations. But yes, you can absolutely have those. Your workplace does not have to have a retirement for you to start funding your own retirement. So yes, if you do have the simple or the SEP already, yes, you also still can be funding for your traditional and your Roth, dependent upon income.
Do you have any additional information you wanted to provide or suggestions for those that are listening?
Absolutely, yes. So a few just kind of little nuances about some of the plans. With the simple IRA, there is an early withdrawal penalty of 25% to withdrawals taken during the first 2 years of participation. There are some exceptions that apply. However, after this period, a 10% penalty would apply to early withdrawals. Again, there are some exceptions. And the 2-year period begins on the date of the first contribution to the plan. There does exist the ability to switch from a simple IRA to a safe harbor 401k in the same year. Beginning in 2024, this is something new, simple IRA plans can switch to the safe harbor 401k during the same plan year. Previously, that was not allowed. And then also, we didn't talk a whole lot about vesting, Chelsea, but all contributions are 100% vested to the employee when they are put in there. So if that employee decides to leave, what you have put in there for them, that is theirs. And then regarding the SEP plans, just a few things there. It's low cost generally for the plan. It's an inexpensive workplace retirement plan, and it requires no special IRS filing. We'll talk about the Owner K and the Form 5500, but the SEP does not require that. The other thing that's unique about the SEP is annual contributions to the plan are not mandatory, and they may range from 0 to 25%. So, if your farmers have a bad year and their tax professional says, hey, it does not make sense for you to try to contribute this year, you have that ability and that flexibility there. On the Owner Ks, this type of plan can be complex because it usually requires the services of an administrator for the 5500 filing and record keeping. These administrative services vary from company to company, but it is like it is a 401k. So there's usually more costs involved there. And the last thing, Chelsea, that I didn't mention previously was that all contributions need to be made in cash.
All right. And just a reminder too, like we mentioned, if you're wanting to consider any of these, whether you just for yourself as an owner and or for yourself as an owner, and if you have employees, just make sure you start looking into them as soon as possible and to make sure you're able to meet some of these different deadlines.
If you have questions about any of these plans, please talk with your CPA. We just want you to be aware of basically all information of the plans, so you're not caught off guard by anything, and you choose the one that best fits your scenario.
Once again, that was a financial advisor with Edward Jones, Alice Tunks-Jones, on the KFMA podcast hosted by KFMA economist Chelsea Plummer. I will link the full podcast episode in today's show notes on agtoday.net, or you can also find it on AgManager.info. I would like to let you know the hosts of the KFMA podcast and Edward Jones have an existing business relationship. This podcast/event is not a testimonial of the services provided by Edward Jones financial advisor, Alice Tunks-Jones. We're cutting to a short break now on Agriculture Today, but we'll be right back. You're tuned in to Agriculture Today, and we conclude our Friday show with a weather update with K-State meteorologist Chip Redmond. Chip, thanks for joining us today.
Yeah, thanks for having me.
Chip, kicking off our conversation where part of the state saw some rain this past week.
Yeah, it was a part of the state that has been pretty lucky over the last several weeks. They've had quite a bit of precipitation, and most of the state saw some rainfall to start the month, but in the last week, portions of central eastern Kansas have started to really dry out, but southwest Kansas, boy, they just got lucky time and time again. Some areas out there, like Garden City, received over 2 inches of rain, nearly 3 to 4, even 5 inches of rain in northwest Finney County. And so parts of the west that really need some moisture got some. And finally, some timely precipitation for those folks. I know they struggled with the wheat earlier, and thankfully it sounds like some of the wheat yields have been higher than expected, so that's good. But we need that for the other crops, too. And this timely precipitation is critical as you look forward in the forecast. But first, we had some drought monitor improvements as a result. We had some total elimination of abnormally dry in portions of the southwest, like Meade County and those general areas that got lucky enough to get timely rainfall. And then as we get further east, we also removed some because of the precipitation the week before at the end of June. And we moved abnormally dry conditions in portions of eastern and even central Kansas as well. So right now, actually over 50% of the state is drought-free right now. And that's not a bad place to be in July, all things considered. But we still have about 21% of the state D1 or worse drought. So there's still isolated areas, mainly in that central portion and some areas in far west central, but drought improvements this week. And hopefully we can keep that momentum going, but the forecast says that things are going to at least slow down rainfall-wise for most of the state.
You mentioned that we're likely to have reduced rainfall, and what temperature can people be expecting with that?
Yeah, so we had a hurricane come through the Gulf and went up to the north and east, and that really transitioned this weather pattern that was very active. We had a lot of rain events and warmer than normal and brought in much cooler air to the central United States, and that's been really welcome. We actually had some below normal low temperatures, not records by any means, but we were cool for quite a few days there. As we look into the forecast, the ridge of high pressure is starting to build to our west, and that's where we watch this time of year for significant domes of heat to move eastward. It's happening. There's a major heat wave ongoing across the west coast. That's expected to shift east into the central United States as we move into the weekend, and so temperatures are going to skyrocket. We're going to be very warm. We'll be over 100 for most of the state. We're also going to combine that with some breezy winds, and that's a factor that really can dry things out very rapidly. So it looks like we'll be in this pattern through middle of next week, and then there's hints that the monsoon moisture is going to wrap back into that high pressure into the southwest U.S. and inject over the central U.S. That could bring some precipitation chances. Right now, highest confidence is further to the west and the western third of the state, but it should hopefully bring some cloud cover and cooler temperatures as we get into the end of next week. So this heat wave is going to last about a week. As we look further out, after this brief cool down by next weekend, the potential for more heat is there as we continue to see that high pressure build right back into the western United States, and we could potentially see our transition that we were expecting. We've been talking this waning El Nino, and we would have a warmer and drier summer. I think that transition's starting to happen across most of the region.
Further past that, Chip, what's the forecast looking like?
So we still have a negative Pacific Decadal Oscillation. We've completely eliminated El Nino. We are in neutral conditions, and those trends favor the forecast for warmer and drier conditions through the rest of the summer and into the early fall and potentially even early winter if we have La Nina truly take shape. There will be a lot depending on the hurricane season. We can get another hurricane in the Gulf. That'll impact our pattern. But we're also watching the Atlantic, where the Atlantic is, if we get a strong, powerful hurricane there, it's going to impact the whole upper level pattern across the United States. So we're watching that carefully, and hopefully that can lead to continued precipitation when we need it.
Chip, I appreciate you taking the time to join us today and give us our weather update.
Yep, thanks for having me.
That was K-State meteorologist Chip Redmond. That's all we have for you this week on Agriculture Today, but we'll be back with more for you on Monday.